Today, we need to have a discussion about what the Federal Reserve and Jerome Powell said about markets and why a June rate cut now becomes the most plausible scenario. On top of that, the DOJ seems to be investigating Apple as soon as Thursday, and the markets rallied to a new all-time high, closing right at the top. So, with huge moves going on around the world, which markets are presenting the best value, and are there still excellent trades and opportunities for all of us? Well, the answer is quite simply yes, and today we'll talk about some of the best movers as we cover stocks, commodities, and cryptos throughout the world. Well, welcome everyone back to the Daily Show where we talk about markets around the world, including macro, lead indicators, and the hottest charts. My name's Tom. Remember to subscribe and smash that bell icon if you love markets like we do, and place a comment down below with your favorite stock or instrument that you're trading or investing in right now. What were the three things happening during the day? Big tech, small tech, and of course, one of our favorites recently, gold. They were moving up heavily along with crypto that was moving thanks to the Federal Reserve. So what was really happening? Well, it seems like the dot plot came in a little bit differently to what the market expected. And in general, committee members were still looking at rate cuts a little bit sooner than maybe some people had thought. So let's get into the meat and potatoes of the FOMC recap. And that means we need to do a bit of a summary. I posted this over on our X account, links in the description down below if you're interested in checking it out. So really, what's the Fed doing? Well, I think they're getting away from the 2% inflation target metric. That's the first thing. The second one is that it looks like we're going to get a June rate cut and that we're going to see a terminal rate that's slightly higher than what we had before. This is the rate basically where we end the rate cuts. And I think it's too early to predict that, but at least that's what was happening on the curve. The three main takeaways from Powell's speech today were these. Firstly, he doesn't seem to care about the firmer January and February inflation data. There could be a suggestion why that is, and it's got to do with the Fed's favorite metric coming up. And the Fed now believes that it may be appropriate to slow the pace of the balance sheet runoffs fairly soon. So again, being accommodative to this market bull run right now. But I think this is the kicker. The FOMC raised its 2024 GDP growth forecast, and it's implying stronger growth has been made possible by faster growth in labor supply. So overall, unemployment kind of starting to look a little bit shaky. That's allowing the overall growth to improve. So basically now job weakness now could warrant a policy response is what they're claiming here. And after all of that, the real kicker was, why did the market truly move? It was probably because it was pricing in around 4.8% expectation of the rates over the 2-year, and now it's getting at 4.6%. So again, supportive of this bull run so far. So now here's the kicker for everybody. You might think, well, that means we're going to get heaps of rate cuts. Well, the market's actually been pricing in strong growth, better than average GDP, and of course, also less rate cuts overall. This was taken last year, and you can see that it was expected to be around 4.24% by the end of 2024. Now we're looking at the end of 2024 being a 4.6% overall. So this is really the change that's been going on behind the scenes. And I guess the market just kind of thought it might be about 4.8. So overall, the price was 4.8. Now it's 4.6. That makes the market happy. And it's just an excuse to push it, of course, higher. In terms of Goldman Sachs, they think that the first 25 basis point cut is going to happen in June. And they also think there's going to be a 25 basis point cut every other meeting or once per quarter through all the way to 2025, with the terminal rate sitting again between that 3.25 and 3.5%. So pretty much on the money in terms of what they're doing. And they're reiterating this today in their discussions. Now, I mentioned there could be a reason why the Fed's not concerned, and I think it's the core PCE result. 2.67 kind of suggests that we might be actually moving down here a little bit when it comes to overall inflation. Now, you can see the other reading was quite high, and March core PCE was 0.23. So maybe that's what Jerome's getting at. Maybe he sees data we don't have yet. But realistically, I think it is exactly as bad as all of us think long term, which is that Jerome Powell, the Federal Reserve, and really the system that we're in is not going to allow the markets to realistically get back into normalization pretty much ever. We're just going to have huge booms, huge busts, and all of the normal things. Now, that really suggests also that we should be looking at buying the dips if they do occur, which so far, of course, they have not. Equities have tended to rally further after the first rate cut if we are seeing easing and is driven by monetary policy normalization. So this is the argument that's going to be made as we see rate cuts come through. And we've talked about the different scenarios. There are scenarios where they rate cut really aggressively. When they do that, you need to be terrified. That usually means a recession. The markets end up selling off heavily. But what if they rate cut in a normalization concept where we've still got growth overall, or even a growth scare? You can see here there's actually quite a lot of overall bullish combos, and this is taken from Goldman Sachs research. And you can see here that there's a lot of bullish combos that will come with it. So again, if we do end up seeing sell-offs over the next couple of months, especially ahead of June, they could be opportunities for us. Now, what's another good read that's happening right now? Well, I think it's the Bank of America bull bear indicator. Now, this one's actually not too bad. We've seen extreme bearish buys, and we've also seen extreme bullish sells that have happened from this indicator, and they've been decent with the market. Again, we want to use price action always, and at this stage, we just don't have any reason for that. But it's sitting at around 6.5. I expect after this week, it's probably going to be about 6.7 to maybe even 7, and we'll update you when we get the data for that. So who were the big winners out of the session itself? Well, I think it was really small cap stocks and metals. And of course, we also saw our gold. Gold coming through with a 4.13%, a beautiful thing. And weirdly enough, it spiked earlier in the session. And then, of course, after all of the stuff with Jerome Powell, it just kept going. Now, usually you see a false move. So you can kind of see here it went up, it went down, then Jerome Powell's speech and everything rallied through. Not quite the type of trade day that you generally do get around these types of points. Often you'll see kind of data come out, it fades, and then you'll pick it up the next couple of sessions. But this was just ripping all the way into a high close. You can see here now the next 5 days, or the last 5 days of trade, were overall best for some of the stock market sectors that we've been talking about recently. And semiconductors are still down on a 5-day average. So it's a very mixed market with so many different opportunities in it. And we'll be looking at quite a few later on today's show in terms of opportunities coming forward, whether you're a bull or a bear in markets. S&P 500 analysis time. What was the big takeaway here? Clearly, it was the close on the high. That's a very bullish close for markets. And again, it suggests that we're moving higher. And it also suggests that we're now in a positive gamma environment because we broke through that 5200 zone, closing also just above 5220, which was another gamma style. And it kind of makes us think that there could be further bullish runs to 5300 at a minimum in terms of the way the market is currently looking. When we take a look here at the underlying, you can see the 5-minute chart or the smaller time frames were really just ripping the whole session. And that 5180 got taken out fairly early in the session indeed. But don't worry, there are plenty of other markets that have got lots of opportunity if you don't want to get into these momentum bases. What about the key levels? Well, really at the moment, it's just these zones. The 5300 will be a key level. 5250 for day traders will be something you look at, as there are some strikes that we'll talk about around those areas. And you can see here in the futures, it's actually starting to rip as well, even higher. So it looks like we might even open with a gap up. Key resistance was taken out. Key major changes for the bears remains at 5090 and 5050 for now until we get more market structure on the left-hand side. So really, it's just going to be more buy the dips for now for the day trades and look at the other market segments that could offer you great opportunities. Let's now move over to the options market. So as we mentioned, we're through 5200 and you can see how many calls are floating around here. 5250 is the next kind of hedge off zone, and that's going to push the 5300 narrative. And then after 5300, it could be a 5400 narrative. So a lot of bullish pressure here in the options chain and not much bearish action yet. So until we get under that 5090 zone, we don't really turn into a major negative gamma environment, at least for now. Here are more the 0 DTE reads in terms of where changes could be happening in the overall daily kind of hedging. And again, 5224, a big point here because we're on the spot price. You can see a whole bunch of calls sitting just behind that. You can also see here that there's just so many calls there that are going to need to be hedged through the 21st of March. And the 22nd of March also has a lot at 5250. So if we manage to push through over the next 24 hours, again, it could be a fairly brisk move to the 5300 zone. And this is where we kind of get into that options discussion. So what's going to be happening moving forward? Well, we're going to need to constantly be looking at this because if we do end up moving into a negative gamma environment, just remember markets tend to go very fast at that point. For now, it's a series of higher highs and higher lows, and it's holding that 20 moving average. More on that very, very soon. Just a quick reminder, if you're interested in anything else we do in terms of the stuff over at FX Evolution or our other socials, you can follow us in the links in the description and pinned comment down below. Let's now move over to the poll, and thanks so much for voting in this. Thousands of you voted, and it was a really interesting poll. So basically the question was, if we could choose any of these particular assets down bottom or instruments and buy and hold them for the next 5 years, which one would you buy? And it was weird. I mean, we had a lot of Bitcoin buyers. 35% of you wanted to hold and basically look at Bitcoin, even though there are usually cyclical periods over that. 26% wanted gold, which I found really surprising. Google was the worst at 19 and NVIDIA at 21. Some other notable comments were, of course, you would get Tesla, which is in there. I saw Intel being mentioned, and quite a few of you, I think correctly, were mentioning smaller semiconductor stocks and a few of those other ones as well. So some great comments there, but I found it really interesting that Bitcoin was number one from the general public that's out there, and of course the community. Now you might think that's all community votes. It won't be. The way YouTube works, it'll push it out to other people as well. So you might say, how is it so much Bitcoin? It's just the hot thing right now. Let's now move over to what's going on with semiconductors and of course this AI revolution. Not resolution, revolution, guys. Morgan Stanley, what do they claim? Well, they're claiming that semiconductors are just the beginning of this overall AI revolution, and that they think there's 2 to 3 stages. So the first stage is where basically we're seeing the semiconductors and really the hardware build-outs. The second stage is the infrastructure build-outs, which they believe is Samsung, Apple, these types of companies. And then the third stage, which is going to be those Google, Amazons. I totally agree with the Amazon component. I think that's going to be so interesting in the future, especially I'm a very big bull in the future on how much they're going to be able to bring down costs and make lots of money. But for now, this seems to be something that Morgan Stanley is plotting out. Do you agree with this chart? Some interesting ideas for future stocks that you might want to hold if you're thinking maybe some of these AI semiconductors are too high. Speaking of being too high, let's have a look here at the bubble that is supposedly happening in the NVIDIA stock market and in general AI stocks. Now, I've got news for you. Generally, when bubble discussion comes up, it's not going to crash. And what I mean by that is we still get pullbacks in time, but they are bought up. It's not one of those epic 80% crashes or 60% wipe-offs. Generally, bubble discussion, when it's there, is not really the time that you want to be getting rid of all of your long-term holds. It's when you get complacency past that point. And that means that people don't believe that there's bubbles anymore and everyone just goes, you know what, to the moon. It doesn't mean retail. It means that you want to see the biggest players in the world also doing that. Reckless leverage, guys. Reckless leverage. And at the moment, it's not quite there. But we'll update you when we start to see that leverage coming through, because that's one of the big things we're looking for. And you can see here, yes, no, and don't know is coming through pretty much 50-50 at this stage. Copper to S&P 500 ratio. I love this chart because it's kind of along the lines that I think. Now, I believe we go into cyclical kind of changes over time. It's been a while since we've actually seen copper or any kind of commodity or metal really do well versus the overall S&P 500. And it did do very nicely back in that previous rally before the global financial crisis. So is it going to do it again? Well, we've recently seen copper break out. We've obviously seen some strength in the copper markets. And this is going to be one of the metals that I believe is part of the AI revolution. So really, when you think about it, copper is in a good place right now at a relatively speaking cheap price. And at the moment, with everything that went on a few weeks ago where we started to see constrained supply, that is going to possibly lead into further bull gains. So copper is an interesting metal. Let's now take a look at risk on, risk off assets in terms of what the ratios are. Well, you can see here that in general, risk on remains very, very bullish. What this is a mixture of pretty good indicators. I mean, of course, copper often considered risk on because the economies are heating up at that point. High yield bonds, also something that we look at because if everyone's buying high yield junk bonds, then it considers that overall we're getting basically a lot of risk that's in the markets. Aussie dollar, it's an interesting one to put in there. Semiconductors, totally agree. And then high beta stocks as well, which is something that a lot of us talk about. Risk off is generally gold, US Treasury bonds, yen, utilities, staples. We have seen an improvement in utilities, but I think that's short-lived. Obviously, I like them until middle of April. Gold in particular, I think this is more of a stagflation play versus BRICS and the SWIFT system. If you're not sure what bricks and Swift are, you really should look that up. Maybe we'll do a video on it soon because this is quite interesting, quite important. But for now, basically risk on is still in these markets. We'll update you if any changes happen here along the way. Let's also have a look at the different sectors. So you can see here that high beta versus low volatility, cyclical versus defensive, still looking very, very strong. And now we've basically got high yield bonds versus treasury bonds as well, doing very, very well. And that basically is telling us these spreads here that high yields are doing so good is that everyone's kind of getting complacent in this market. We already know this, but this is just confirmation of that complacency. Let's now take a look at the S&P 500, 1500, new highs breadth dashboard. And again, it's showing you here that energy sector has been kind of the breakout recently. No new news for us. We've been on top of this one because we look at the price action as the overall. We saw it as the weakest, crappest sector about a month ago. And of course, we've seen rotation into it. It's amazing how that happens. Then everyone discusses it 2 days ago, and then it falls off. So yeah, it's getting good reads. I do think energy could still piling in, and we'll look at it very, very soon. But this is an interesting level. Of course, breadth is also improving. You can see here large cap breadth is pretty good. We're looking for small cap breadth though, because mids and smalls are where we actually have a lot of weakness. So percentage at 1 month lows, quite worrying here. Percentage at 1 month highs, not right there just yet. So again, the mid caps are really where probably the biggest opportunity is right now. Then we're going to be moving into the small caps. And I think that the small cap, particularly the high kind of really debt-fueled businesses like those ARK-style businesses, those ones are going to have a good rip if we end up getting these cuts from the Fed and the market truly believes they're coming through. They are so suppressed in the market right now. So why is the market so bullish? Well, everything's looking good. We've got earnings per share going up. We've got GDP forecasts going up. We've got generally AI earnings looking pretty good. If you actually ripped out basically 480 stocks out of the market, it may not look as good as you think out of the S&P, but overall, the big ones that count are currently giving us what we need. And that's leading us into looking at these, of course, metrics. So in the last couple of days, we've been talking about this particular chart. And what it's showing us is that over the last 100 days, these are the most correlated markets. We're now at about 105. And there were markets that ripped a little bit higher. But in general, there was a lot of choppiness that seemed to come out. And I think that's going to give us really good trades, really good potential investment opportunities and rotational opportunities. So for now, the market's quite bullish. But of course, that's the kind of thing that happened in previous scenarios. 62% of the FMS investors say that soft landing is now coming. We already talked about this. When people believe something, it's usually wrong. In general, there's no landing is 23% now. Hard landing is gone, so no one even cares about that anymore. And soft landing is starting to lessen as no landing becomes the discussion point. I would say that it's probably some form of landing, then not the no landing, but time will tell how it ends up. Dividend yield relatively inexpensive versus history, a chart that we brought up. A few of you were asking what kind of stocks should we be looking at for this. We'll bring them up very, very soon, but I thought it was a good chart to bring in. And of course, this is the one that I think is bricks versus Swift all over, which is central banks purchasing the absolute rubbish out of gold. Basically, they are buying gold hard, and that's leading to the price. Stagflation concerns are leading to the price. People's concerns about the economy in general leading to the price. And lower interest rates are also helping out. Do remember we're overdue for a correction. Doesn't mean it has to happen, but we're now at probably about 90, 95, 98 days. The average is 67. The Fed did not give it to us this week in terms of any types of price action. So for now, as long as you're above the 20 moving average on the S&P, it's risk on, risk on, risk on. And we've said that for a long time now. Unless we get underneath that zone, it's really just look for opportunities. And I think that when we're in a VIX underneath 20, should be single stocks, sectors, and other instruments. And that's one of the cool things. Turns out someone probably knew that this was coming because there was this weird amount of prints that came through. A huge amount of block trades came into the S&P 500 trust pretty much just on the day of the overall announcement. So there was maybe some loose slips out there. And I just wanted to reiterate as well that Tesla may be bottoming with a big transaction that could be defended if we do end up moving down. A nice session for Tesla and a good little bounce as the news starts to turn from super negative to maybe a little bit more positive. The options market overall was not that interesting. Of course, people got involved in Chipotle because that's got the stock split on it. By the way, your comments, there weren't that many actually, but overall Meta was probably one of the better picks in terms of what you guys thought. But do always share. If you ever see something or you think something, we're reading all our comments at the moment. So make sure, put them in down below and we'll check them out. Thank you very much. It always does help out when you put them there. Retail traders were 31% of the market, and you can see here that total options value was well down on the average day. Now let's get into the charts. So we mentioned that bonds markets were not concerned coming into the FOMC. They really weren't. High yield junk is actually breaking, or almost breaking out, not quite yet. So we're in this channel. Now, if it does break to the upside, markets may rip a little bit more, and that's because basically it's saying that we're taking a lot of risk in. Now, there is some scenarios where it could do this, and that would, of course, be a false break, and we would really be interested in that if it did occur, because that would show you that maybe the markets are starting to get fearful. But really, it's this chart here that we've been talking about. We saw a little bit of an uptick a few weeks ago in this, but really it's just been continuing to go down. And what that's telling us here is that overall, there is no fear in the bonds market. And until there's fear in the bonds market, e.g. other previous pullback times, this is usually an early indicator. And we'll keep updating you on this if we do end up getting updates. Our other bonds indicators also are sitting in sideways style markets, coiling their way through. So again, no signs of weakness coming through these. Also no signs of weakness in home builders at this stage. They're absolutely ripping after the news, and they've done very well in the last couple of sessions. US 2-year got through 4.77. I actually posted on X. I saw it go early, and then it just dropped straight back down. So it would have stopped a few people out that were trading the yields. Overall, though, it's dropped back down. I think the big difference here is going to be 4.4. So if we get underneath 4.4% in the future, then that's really showing you that probably the peak's in for the US 2-year, and it's going to move in the down session. Now, I'm not necessarily convinced by anything really in terms of the overall yields. I think that yields could still move up. It's possible, as we're seeing a lot of metals running through, and the Fed's not really doing much about it. But obviously their core PCE, they must feel confident on that figure. I'm looking at the 4.4 very closely, something you'd be watching and looking at. Now let's move over to Federal Reserve and in general central bank support. It seems to be dropping a little bit. So even though the market's ripping, we are seeing a drop off in central bank basically support of the market. So this is a mixture of so many of the different ways and tools that they do support markets. It's dropped in recent days, probably nothing noticeable yet, but we'll keep tracking it and obviously bring it to your attention on the show. Treasuries held their own, basically just held the defensive position. And we saw a bit of a difference between the US 10-year and 2-year, etc., in terms of the overall days. So that's why it's kind of hovering around. But this is a decent area if you're a believer in treasuries moving forward and believer in plenty of rate cuts coming. VBR, I thought we'd bring this one up. Vanguard small cap value ETFs. Take a look at this. So it actually has a very strong weekly close if it manages to do it above the previous 2 weeks. And VBR was riding pretty well on the session, up 1.45%. So this is basically small cap value ETFs. You can see they've been in a nice run recently, and they might be breaking out for further running potential. And this is where you're really going to have to start looking. Mid caps, small caps, there is a lot of stocks out there, or there are a lot of stocks out there that are improving across the board that could be looking quite good. What about copper? We've been on this one very, very early. Still holding up, still bouncing. At this stage, copper looks set to be in a bit of a bull run. So it bounced off this little long leg doji here, which is really nice. And if it does make a new high, then I think we're going to 4.4% for copper. So it could be some good times ahead for the copper and copper stock style traders. What about value versus growth? We see here that growth is improving. So it's actually growth versus value, my bad. And you can see that it has come off that base. So again, the 20 moving average, this red line behind. For now, growth is still the better sector than value. That will change at some point, though, to give us some nice rotations there. US dollar. Now, if it closed like this, that's a very bad sign for the US dollar, and it points towards further weakness. In some ways, this is possibly one of the better trades moving forward as well. We saw euro hold up, obviously, over the last 24 hours, and you can see here that there's a big engulfing candle. So what that is it came up, took into these dojis here, grabbed the supply, and then dump straight back down. And it does suggest, at least at this point, that the dollar is going to go through continuous weakness. it has kind of changed its series of higher highs and higher lows to now a lower low, and it's changed a little bit of trend on the smaller time frames. So maybe a little bit of a buy up and then sell off, but this is looking weak for the US dollar, obviously strong therefore for the euro and other currency pairs. Aussie dollar as well holding up quite nicely on that level. Now let's take a look at gold. So you can see here that gold is in a nice rally, and I've kind of just taken it as a flag. So we can look at here as the breakout and then where that flag would project. And funnily enough, it comes in at 2,300, which has been a short-term target for me for a while. So a breakout of the flag suggests that gold's on its way. I like GDX way more than gold because I think gold stocks are still super undervalued compared to gold overall. And if you have a look here at the GDX versus gold combo, and this is not the one I would usually use, again, GDX coming back with some strength, and it looked really nice. And overall, GDX looking pretty good on the charts. This is gold miners. There's plenty of better gold miners, but they're kind of like a nice trade because if you're scared of the economy or you're scared of things, maybe you feel more comfortable in gold being something somewhat of a hedge against the beginning of recessions in markets. But it is a very interesting metal this year. US oil bounced off the little miniature demand that we have here over at 81. It still is long. It's still in the upward trend. I am a little cautious against oil because everyone started talking about it. Obviously hit our TP zones, but this is the demand it needs to hold. I'd like to see oil rebound from here, move past, and obviously get back into that 83, 84 a barrel. And that to push through, further possible inflation issues. PayPal, one of our favorite stocks from last week, continues up. So this is doing really, really nicely here. Great session for it, 3.24%. Just shows you there are tons of different trades out there, and it had a really nice one across the board. Now let's move over to semiconductors versus the SPY. So not that much semiconductor movement. It was up 0.67. It wasn't really super strong for semis. There were actually better other markets that were doing quite well, and Tesla was one of them. Tesla moved up very heavily. So in the previous sessions, we've talked about this possible return point. We have seen buyers from it. Nicely, we've seen mostly wicks. So you can see here, comes down, wicks up, comes down, wicks up, comes down, wicks up. That's a good sign. Now, I like to think that wicks hold excitement in the market. So when you start to see wicks in your favor, in the bullish favor, that does point to these levels being defended. And we already know there's a huge trade or decently large trade that's gone through down there. To really get the end of possibly a sell-off on Tesla, we're going to need a 182. But it's an exciting stock that's doing some nice things in the markets right now and certainly improving. NVIDIA continues to hold the 850 as well. So between 850 and 920 is its stuck zone. So a lot of people are very interested in this chart and very interested in NVIDIA at the moment. And I kind of expect it to do a little bit of sideways action for a while. But 850 is the support, 920 is currently the resistance on this chart. And it looks like it's trying to go back for 920. Just to show you, there are other sections. We've been mentioning utilities a lot recently. And you might say, Tom, utilities, dude, that is so ridiculous. What are you talking about? Well, this is a pretty big utility. It's Nextra and NEE, and it's done really nicely. Since we've been talking about it, it's actually probably done better than the market itself, which has been a breach and a movement up here of 10.43%. Now, it's all about risk reward, and this is about a 3-to-1 trade. So ratio-wise, it's doing very nicely. It's getting close to the first major TPs here. But yeah, nice breakouts. You can see it's continuing to strengthen, continuing to close near its highs. And you might be surprised how bad this stock has been. So sometimes there are opportunities in different markets. And if it does end up breaching further, it could go all the way upwards of around $67 to $70 per stock. I do think it's going to be short-lived, though. The love for utilities doesn't tend to last that long. Qs versus SPY, this is a combo we talked about that really showed the S&P would outperform the Qs, and it was possibly a sign of weakness in the market in terms, so far it's been really just rotation, which has been from semiconductors and some of those other tech markets into the S&P overall, but that's been a pretty interesting channel. And this is a very good one. I mentioned this in our Market Masters Club. It was my trade of the day in terms of something that I was looking for, and what it was a breach of 2050 bringing the super bulls in. And it just went ballistic. You can see here the huge squeeze that was on the small caps. And the US 2K really bounced up. Very nice high steal. And that's suggesting that pullbacks will be met by bull demand. And it's certainly a market that we'll be looking at quite closely. Obviously, we've talked about how it was the last point where it needed to find buyers, because so far we've had this ascending channel. We've had it on the markets for a while. But where it might get even more interesting is a 2120 breach. So 2100, 2120, if we get a weekly close above that, I think it's going to be really on for small caps. So some exciting times ahead potentially for that one. Now let's move over to the NASDAQ. So it had a really nice candle in the previous session with this bullish buy up. Obviously, we know this was a defended zone by huge amounts of traders, and the bears just couldn't push it down. If they had, it'd be on, but it's not. So it's on for the bulls for now, and they're pushed it to this high. It is possible we have false break narratives. We'll be, of course, on the lookout for those. But really with the closes as they sit, if you have a look at the Q here, the Qs closed right on their highs. So it's suggesting that it's more rallies to come. And of course, 450 would be the expectation of the first hit, if not even more. What about Bitcoin? Nice rally off the first major level. Now, this is certainly the first major level. Can we believe in this rally yet? Yes and no. Let's have a look at the two scenarios. So the first scenario is that I really like the fact that it broke through 66. To me, 66 equaled where we are right now, which is that 68 kind of 7 zone. So that's a pretty easy move, but we do know that this is where everything changed. We went from support to resistance, or basically we went to supply here, and this is still a supply. This is where the bears have sat, and for major bulls of Bitcoin, if we manage to get above these highs here, I think we're going to a new all-time high. But for now, it's still stuck in this area. Pullbacks, I think, will be met by bull demand, at least initially, due to the day trading kind of process and the way that the market's changed now. It's going to give dip buyers, a little bit more confidence to be looking at that 66,000 or something around there. If we do manage to get under 60K though, I think we're really going down all the way to around 50,700. So at the moment, Bitcoin, it's at the res, it's looking really positive, but still got a little bit work to do. If you enjoyed today's show, remember to subscribe, smash that like button, follow us in the socials down below, and do remember there's still some information coming this week. Most of the information is from the Eurozone, and then we have Fed Chair Powell coming to annoy us again Friday, March 22, 9 a.m., and he'll be having a nice chat. All right, everyone, thank you so much. Thanks for watching. Comment down below on your favorite instrument or stock right now, and thanks for participating in our polls as well. Much appreciated. See you in the next one.